Hello. Welcome. For those of you who are watching me for the very first time, my name is James Ambroise, and on this channel, we cover how to pay off debt faster than any other debt repayment method out there. We cover basic bookkeeping and accounting for someone who just started out a small business. We cover basic personal income tax to include the Schedule C, Schedule E, depreciation. I am also the author, creator of Ambroise Method 1.0. Ambroise Method 1.0 is a revolutionary debt repayment method that offers greater results in terms of reducing interest costs compared to debt snowball, debt avalanche, velocity banking. Real quick about my credentials. I have been or am a bookkeeper and accountant, QuickBooks Pro advisor, senior tax advisor, residential real estate investor, residential property manager, financial coach. And as always, before we get started with what's on the board, please allow me to shout out the name Jesus, my Lord, my God, my Creator. Thank you. All right, America, on the board we have this hypothetical scenario of somebody who filled out one of my Microsoft Excel worksheets, and the person provided me with these figures. For debt, this person has a Wells Fargo credit card, Capital One credit card, Chase credit card, Navy Federal loan, Regions HELOC, and a first mortgage. Okay, and for APR, 20%, balance owed, 4,000. Payment rates charged, that's how much they're being charged currently on that account, $80. Again, this amount might vary, but for this particular month, it's $80. Availability, we've learned on lesson 1 that the availability is the relationship between the credit limit and the balance owed. And that relationship, America calls for a subtraction operation. 5,000 minus 4,000, that's how we arrive at 1,000. Okay, credit utilization is the relationship between the balance owed and the credit limit. That relationship calls for a division operation. So 4,000 divided by 5,000, that's how we arrive at 80%. Payment rates charged is the relationship between the monthly payments charged and the balance owed. And that relationship calls for a division operation. $80 divided by 4,000, that's where we arrive at 2%. Okay? Now let's move down to more items. Income, 2,500. 2,500 for income. And expenses, 2,300. Debt, when you add all the balances, so the debt is at 187, and cash flow, you know, to get to cash flow, it is the income minus the expense, so 25 minus 23, so that's how we arrive at $200 cash flow. Okay? Now, real quick, keep these in mind, a credit card versus a HELOC. Okay? The credit card, the credit card is revolving. An HELOC could be revolving. Because understand though, in this particular example, we have a 10-20 HELOC, which means the first 10 years, that's the draw period. The remainder 20 years is the repayment period. So during the draw period, right now we're on year 1 of 10, that means this HELOC is in the draw period. During the draw period, it is revolving. Okay? So after the 10 period expires, so now we start repayment period, it's not going to be revolving any longer. Okay, so understand the difference, because sometimes I notice you guys kind of send this thing the wrong way on YouTube. Okay, and again, during the draw period, it's revolving, which means you could use it and reuse it. During the repayment period, you cannot use it and reuse it. Okay. But right now we are in the draw period, and we're in year 1 of 10, okay? For computation, the credit card is computed mostly average daily. mostly average daily. They're not always average daily, okay? Some credit cards are not average daily, but most credit cards are average daily, okay? The HELOC is average daily, okay? As far as liquidity, the credit card may or may not be as liquid, okay, as an HELOC, okay? Why? Because you know sometimes we have folks who only have a few items. For example, a student, for example, a young man going to college, okay? His parents is responsible for most of the items. That young man is only responsible for a few items. If all these items can go on a credit card, well, the credit card is 100% liquid. Okay, but we know for most folks, you know, some of the expenses cannot go on a credit card for most people. So in this case, it's not as liquid as an HELOC, okay? And we know HELOC usually offer greater liquidity compared to a credit card, okay? As far as term, a credit card is open-ended, so you could use it and reuse it for lack of better terms. And for the HELOC, during the draw period, you could use it and reuse it, but during the repayment period, you cannot use it and reuse it, okay? So this is some of the difference that I wanted you to be aware of. All right, America, I'll give you about 5 seconds to take a look at what's on the board, and then we're going to start with the exercise, okay? Real quick, the person likes velocity banking, and the question posed to me was, James, is there a way that we could do better than velocity banking in terms of reducing interest costs? Okay, 5 seconds, take a look at the board, and we're gonna start. All right, here's some stuff. And again, person likes velocity banking, so we're going to start with velocity banking, okay? Okay, these guys, my competitor, velocity banking, they usually go by 2 different formulas. Sometimes they look at cash flow, and then since there's a HELOC on the board, they might look at the HELOC. When we look at cash flow is only $200. So the formula for cash flow is too small, is not comparable compared to the HELOC, because when we look at the availability, 1,012, 30, 13, 64, 0, we see that the HELOC has an availability of $20,000. Okay? So the formula for cash flow not comparable, so we're gonna go with the HELOC, $20,000. Assuming that they wanna go 80% of the credit limit, okay? So let's see what that is real quick. So we got the HELOC, the region HELOC. $50,000. And again, we're assuming they want to go 80%. So 50,000 times 80%. Let me grab my calculator real quick. 50,000 times 80%. So we had 40,000. Okay. But they've already have a balance on the HELOC, and the balance is 30,000. So the max they want to go is 40, but they already owe 30. So 40 minus the 30, which means they could use up to $10,000 to pay off debt. Okay? So $10,000. Now with that $10,000, we're trying to follow what some of the folks on YouTube are doing, dealing with velocity banking. So with that 10,000, let's see on the board we have 4,000 for balance, 6,000, 10,000, 21, 30, 16. Okay. Sometimes these folks they follow that snowball. So in this case, they will pay the 4 and the 6. Okay. Whether that is a good thing or not, we're going to cover that a little later. But for now, let's attack the 4 and the 6 with the $10,000. Okay? So, Wells Fargo. So we said they want to attack Wells Fargo. So the credit limit will stay the same for Wells Fargo, 5,000. The APR, 20%. The balance owed, remember now they have $10,000 that they want to use towards paying off debt, so the balance owed for Wells Fargo is going to become 0 because they're going to pay off the Wells Fargo. The monthly payments charged, balance is 0, so the monthly payments charge is 0. Availability, remember availability is credit limit minus balance owed, so 5,000 minus 0 is 5,000. Okay. Credit utilization is balance owed divided by credit limit, so 0 divided by 5,000, so we have 0. Okay. Payment rate charge, monthly payments charge divided by balance owed, so 0 divided by 0, so we have 0. Okay. Next account that they want to attack will be the capital one. The limit 70 to 30. Okay. APR 2399. Balance owed. Now remember they have $10,000 to use towards debt. The 4 got taken out. Now the 6 will get taken out as well. So balance owed will be 0. Monthly payments charge, since the balance is 0, monthly payment charge will be 0, at least on paper. Availability, again, availability is credit limit minus balance owed, so 70 to 30 minus 0, so we had 70 to 30. Credit utilization is balance owed divided by credit limit, so 0 divided by 72, we had 0. Payment rate charge is monthly payments charge divided by balance owed, so 0 divided by 0, we had 0. Okay? All right. So far, they've attacked 2 accounts. Chase, again, they've only have $10,000 to pay off debt. Now, the entire $10,000 is completely gone. $10,000 fully exhausted, so no more money left. Okay, so Chase, so we're not gonna touch Chase, so Chase will stay the same. Okay. 11,364, remember Chase stays the same. 21%, 10,000, 200, 1364, 88, 2%. Navy Federal loan did not touch that, so Navy Federal will stay the same. 21, 2.50, 21, 460, 0, 100, 2.19. Okay, next item is the HELOC. Now, we did use the HELOC to pay off these 2 debts. So Regents HELOC. Okay, credit limit 50 grand. APR 3.99. Okay. The balance owed. Now the balance owed, you went from 30 to the max allowed 40. Well, so now it's 40. The monthly payment charge now since the balance changes, the monthly payment will change. Okay, so let's see. We got 40,000. Remember, it's a Regents HELOC, so on this one, they are interest only. So 40,000 times 3.99% divided by 12. So we are 133. As you could see, America, it went up from 99.75 to 133. Okay. The availability, remember availability is credit limit minus balance owed, so 550 minus 40, so we are 10 now. Okay. It used to be 20, now it's 10. For 50 minus 40, we are 10. Okay. The credit utilization is balance owed 40 divided by credit limit, so 40 divided by 50. So this one went from 60 to 80%. Okay? And the payment rate charge is monthly payments charge divided by balance owed, so 133 divided by 40,000. We are 0.33%. Okay? So next item is enter first mortgage. Enter first mortgage. And again, we did not touch enter first. All we've touched was these two plus the HELOC. So enter first mortgage stays the same, America. Okay? 116, 554, 350, 9970, 069. Okay, we got 1, 2, 3, 4, 5, 6 item. 1, 2, 3, 4, 5, 6 item. Perfect. Okay. So, and again, we had $10,000. Okay, for the region HELOC. These folks, my competitor, Velocity Banking, was willing to go 80%, so that's 40,000, but they owe 30, so we're down to 10. With the 10, they knocked out Wells Fargo credit card, and they also got rid of Capital One 6,000. Now, earlier I mentioned to you guys that sometimes these guys follow that snowball, and we know from lesson 1 that was not the right way to go. We would have been better off if we paid the $6,000 Capital One at 23%, but the next highest APR on the board is not 20, Wells Fargo 20%, it is Chase 21%. So they should have made a partial payment to the Chase instead, okay? But they didn't do that, they do 4 and a 6, but we know we're gonna have greater results in terms of reducing interest costs if we made a partial payment to the higher APR, okay? By employing Ambroise's partitioning a balance. Let me quickly put that on the board. And again, that was in lesson 1. We covered Ambroise's partitioning a balance in lesson 1. Partitioning a balance. Okay? And real quick, on lesson 1 we did cover that, but Ambroise's partitioning a balance, America, is to divide the balance into at least 2 separate parts where one of the part will equal the other account we're trying to compare it with. So if we were partitioning the 10,000 balance, like I said, it's on lesson 1, so please go ahead and watch lesson 1. So it would have been 4,000 plus 6,000, that would have made up the 10,000. So now we would have 4,000 at 21% and 4,000 at 20%. So if we have 4,000 at 20%, and 4,000 at 21%, we'll pay the 4,000 at 21% because we wanted to have an apple-to-apple comparison to figure out which debt should we pay first. In this case, it would have been a full payment to the Capital One and a partial payment to the Chase, okay? And again, these folks, they did not go that route. Sometimes they follow that snowball, which is wrong. But for this example, we're just gonna ignore that they've made this mistake. We're gonna continue with the exercise, okay? And another thing that they do, sometimes they account for the cash flow, okay? For paying off Wells Fargo now, monthly payment is 0, which means they collect that cash flow, which is $80, okay? And they've also paid Capital One $120 of, again, they collect that minimum payment in cash flow gains, which is 120. So in total, it's $200. But the mistake that they've also made, a lot of times they don't take into account that when they made the transfer, the monthly minimum payment on the account that they transfer out of, that monthly minimum payment got increased. Remember, you went from 99 to 75, 99.75 to 133, and sometimes they forgot to account for the increase on the account that they use to chunk out of. Okay, so this cash flow should be less than $200. So, which means that this cash flow is overstated because, like I said earlier, they did not take into account the increase on the account that they did the chunk out of. Okay, and again, this is another mistake that they've made. Just to keep it things simple, we're just gonna give it to them, let them have that mistake. So far it's two mistakes, one here and one there, but that's okay. We're just gonna allow them these two mistakes for now. Okay. Now, income will stay the same. Let me erase this real quick. The income will stay the same, 2,500. Okay. The expense, remember, they've gained $200. Okay. If we're using this number, okay, that's the mistake on, and not that number. So 23. So the expense went down to 21. Okay. Okay. The debt stayed the same because all we've done was reorganize, reshuffle. So the debt stays the same. And again, the debt was when you add all of these, 116, the 30, the 21, the 10, the 6, and the 4, we should get 187. Okay. And finally, cash flow. Remember, cash flow got increased by $200, and cash flow is the relationship between the income and the expense. That relationship calls for a subtraction operation, 25 minus 21. So we had $400. Okay. All right. All right. All right, America. I'll give you about 5 seconds to take a look at the board while I transfer some items in that corner because we're going to erase some stuff from the board in about 5-10 seconds. All right, America. Now, my board is too small, so I'm going to need some room. So let's just isolate a few items because we're going to start doing velocity banking now on the ELOC. Remember, we're mimicking what our competitor is doing over at velocity banking. Okay? So the balance for the ELOC is 40,000. And the APR on the ELOC is 3.99 in the region's ELOC. And after we paid off these two, the next highest APR on the board, we got 21, 2.55, and 3.99, so 21. So Chase is 21%. And the balance on the Chase is 10,000. Okay. For income, 2,500. Expense 2,100, which give us a cash flow of $400. Okay. All right. This is all the numbers that I need for now. Let me start erasing stuff from the board so we could start doing velocity banking on the region ELOC itself. And again, we're mimicking what our competitor is doing over at velocity banking. Okay. Again, guys, you know, I always like to go live, so some of my video are a little longer because I go live 99% of the time. Okay, so at least that is my style. That way we could do the exercise together, America. I don't like to put too much stuff on the board. All right, velocity banking. These guys, they usually have, let's call it current. Current balance. And next item these guys usually have is the interest rate. And they have daily rate. Okay. Then you have income coming in. Okay. Results. Interest rate. Daily rate. Okay. And then these guys have expenses going up. Results. Interest rate. Daily rate. 1, 2, 3, and then since we have 3 items, they usually go average daily, total, then number of days, okay, and then the interest charges for the month. Okay. And these guys usually have effective rate. Okay. And that's usually where they stop. And let me add a few items. Original rate, effective rate, and the difference in savings and savings percentage. Okay, and we're gonna do the same thing for the let's call it original interest charges effective interest charges, and we're going to also have difference in interest cost savings. Okay, and make sure I don't make any mistake. Current interest rate daily rate, income results interest rate daily rate, expense result interest rate daily rate, average daily number of days, interest charge for the month, effective rate, original rate, effective rate difference, original interest charge, effective interest charge difference. Okay, Looks like we okay. All right. Now, we're going to do velocity banking on the HELOC. Remember, the HELOC balance was $40,000. Okay? So, 40,000. The interest rate on the HELOC was 3.99%. And let's figure out what's the daily rate is. So we have 40,000 times 3.99% divided by 12. Divided by 365. Okay? So we should be at 4.3726. Okay? Now, income comes in. Remember from the exercise, income was 2,500. So 2,500 comes in. And income reduces the current balance. So 40,000 minus the 2,500 that comes in. So we are 37,500. And again, we're trying to mimic what the folks over at Velocity Banking is doing. Okay? The interest rate, 3.99%. Okay, 3.99. So the daily rate is going to be the 37,500 times 3.99 divided by 365. Okay. So we got a new daily rate of 4.0993. And by the way, the reason why I don't start after 2 decimal points is because this time we're not going to mimic what the folks at Velocity Banking is doing. We're trying to mimic what the banks are actually doing. The bank, they don't start at 2 decimal points. They start at more numbers. But for us, 4 should be enough. But they have more than 4. I'm talking about the bank. Okay? Then we have expenses going up, and expenses was 2,100. Okay, so the new results now, so we had 37.5 plus 2,100. Plus 2,100. So we should be at 39,600. And the interest rate 3.99, which give us a daily rate of 39,600 times 3.99% divided by 365. So we have 43289. Okay? Now, for average daily, we have 1 item, 2 item, 3 item. Okay, so let's add them up. So we got 4.3726 plus 4.0993 plus 4.3289. So we should be at 42669. Okay? In the number of days, another mistake I've noticed my competitor is making, on the number of days, it's always 30 days, 30 days, 30 days. Now, we know we have common year, which is 365 days, and we have leap year, that is 366 days. Not every month has 30 days in it. So my competitor always go 30 days, 30 days. Not every month has 30 days if the bank goes by the number of days in a month. If they go by the cycle, not every cycle has 30 days. So whichever one, it's still not 30 days. Okay? Now some month it will be 30 days, some cycle it will be 30 days. But some month it will not be 30 days, and some cycle it will not be 30 days. But for this example, we're gonna use 30 days just like they do. Okay? So now the interest charged for the month we got the daily, that's the average daily, that's 4.269 times the number of days. Okay? So 4.2669 times 30 days. So we should be at 128. 128.01. Okay. Now the effective rate, let's see what we got. Should be 3.89%. Okay? That's doing velocity banking on the HELOC, 40,000 for 1 month. Okay? Now, how do we measure that these folks over at velocity banking are doing the right thing? Okay? So let me introduce to you, America, one new terminology. It's called Ambroise's wash technique. Sometimes I refer to it as Ambroise's wash options or option. Okay, so Ambroise's wash technique. So what is it, James? Well, Ambroise's wash technique is a technique whereby the same dollar amount of income that goes into the alternative account is the same dollar amount of expenses that go out of the alternative account. Okay? So for example, if income is $2,500, expense will be $2,500. If income is $10,000, expenses will be $10,000. If income is $3,000, expenses will be $3,000. Okay? And again, same amount of income that goes in, same amount of expenses that goes out. Okay? And that is Ambroise's Ambroise's wash technique. In other words, they cancel each other at 25, 25. It's a wash. Hence, Ambroise's wash technique. Okay? Now remember, if velocity banking is going that route, the question posed to me was, James, is there a way that we could do better than velocity banking in terms of reducing interest costs? So we're trying to give you guys one quick way to do better than these guys. So we're going to employ Ambroise's wash technique. Okay? So with Ambroise's wash technique, the current balance will stay the same, 40,000. The AP interest rate obviously is the same, 3.99, which will give the daily rate same, 40 times 3.99 divided by 365 should be 43726. Okay? And in this example, by the way, the HELOC keeps the cash flow. Which was $400. Remember, they got 25 in income and they got 21 in expenses. Okay, so remember 25 minus the 21 was, that's how we arrive at that $400 cash flow. Okay, so HELOC keeps cash flow when velocity banking when we're doing velocity banking. So now we're gonna go a different route whereby the HELOC will not keep the cash flow. Okay, so the income stays the same, 2,500. Okay, so we have 40 minus the 25, so we should be at the 37,500. And the interest rate, 3.99%. which give us a daily rate of 4,993. And again, the daily rate was from 37,500. We've done it already, but let's run it one more time. Times 3.99% divided by 365. So we should be at the same 4.0993. Okay. Now remember, we're employing Ambroise's wash technique, so which means the expense will be the same as the income. Okay. 2,500. Income is 25, expense will be 25. It's a wash. They are equal. Okay. So now expense is 21. So what's our new total? Our new total is the 37,500. Income is added to it, so plus 2,500. So we should be down back to the 40. Okay. Okay, and again the interest rate 3.99%. All right. So the daily rate should be this one, but let's run it one more time. 40 times 3.99% divided by 365. So we should be right here. 43726. Okay. The average daily, again, we got one item. Two item and three item. Okay. All right. So let's add them up. 43726 plus 40993 plus 43726. Okay, divided by 3, so we should be down to 42815. Again, 30 days. So now our interest charge for the month is 4.2815 times 30 days. So we have 128.45. Okay. Then the effective rate is 3.91%. Okay. So we are 3.91%. All right. Real quick, in this example, the HELOC keeps the 400 cash flow. In this example, all the income goes in, all the expenses goes out, which means the HELOC does not keeps the cash flow. Does not. Okay? So, if the HELOC, when we go that route, does not keep the cash flow, now where does the cash flow goes? So now we'll send the cash flow instead to the highest APR account, which was the Chase at 21%. Okay? So now Chase receives the $400 cash flow. Okay? Here, they did velocity banking and they keep the cash flow. Here, we also do velocity banking, but we send the cash flow somewhere else. Okay? So here, velocity banking, plus they keep the cash flow. Here, velocity banking, but we send the cash flow. We don't keep it, we send it to Chase. Okay? Now, real quick, even, let's talk about the interest charge for the month. As you could see, when they keep the 400 cash flow, the interest charge is 128.01. when we go a different route, we do not keep the 400 cash flow. Our interest charge is 128.45. So now we're being charged more for not keeping the 400 cash flow. Here they're being charged less for keeping the 400 cash flow. But how much is the difference? Let's find out. 128.45 minus 128.01. Looks like we got 1 into 5, that's 4, 0, that's 4, and then 0, 0. Okay? So the difference in savings for keeping the cash flow is only 44 cents for these guys. So in addition to that difference in savings, they also use the cash flow because they keep it. So they also saving $400 at 3.99% divided by 12. So for the month, for keeping the cash flow, we have $400 times 3.99% divided by 12. So they also save on the $400 payment itself, because remember, the 400 remains inside the HELOC, so that's a savings, okay, of 133. So now for doing velocity, these folks savings two different places, this one and that one. So when we add these two up, the 0.44 plus the 133, let's see what we got. 0.44 plus 1.33, so we at $1.77. Okay? So for keeping the cash flow and the saving at two different places combined, it's only a depressing $1.77. Okay? Now, we know that Chase, remember we were a different route. We employ Ambroise's wash technique, so we could send the cash flow somewhere else. Now the effective rate still got reduced. Remember, we started at 3.99, okay? The effective rate still got reduced from 3.99 to 3.91, okay? So for doing velocity, even though the numbers are the same amount of income, same amount of expenses, the effective rate on America still got reduced, okay? And again, we know that Chase, for each dollar that we borrow, Chase will charge us 21%. The reverse is also true. For each payment made, we will also save 21%. Okay? So $400 times 21% divided by 12. Let's see how much that is. So that's $7. Okay? So over here, they did what they need to do, and these guys only save a combined $1.77. Here we send the cash flow to another account, and we save $7. And not only that, we didn't even account for the minimum payment on the HELOC itself, because remember, the minimum payment was like $99.75 if I remember, or $133. Okay, we didn't even account for that, because all that will also be added to the $400, which means we'll save more than just $7. We didn't even account for it, okay, because we don't even need it. Watch, they were able to save $1.77 for keeping the cash flow. We were able to save $7. So which one is more savings? They save $1.77. We'll save $7 for the month. And again, $1.77 $7. Okay, so here we are able to save more than Velocity Banking when they keep the $400. Okay, by the way, this is not Ambroise Method 1.0. Okay, I was just answering the question that somebody asked me. Is there a way that we could do better than Velocity Banking in terms of reducing interest costs? We just show you. Okay, in terms of reducing interest costs, employing Ambroise's wash technique and sending the cash flow to the next account with the highest APR, okay, so you will do better. Okay, $7 here, only $177 there. Okay, and again, this is not Ambroise's Method 1.0. Okay, Ambroise Method 1.0 follows a separate, unrelated process. We don't do that stuff. Okay. All right. Okay, America. I'm gonna give you about 5-10 seconds to take a look at what's on the board, and then I'm gonna start erasing stuff from the board. All right. Okay. Ooh. I should get some of these. Let's see. So next we're going to talk about comparing an ELOC with a credit card real quick. Okay? So over here we got credit card versus an ELOC. Okay? So I should have kept some of the stuff on the board, but that's okay. Current balance. What was it? Interest rate, daily rate. To see, when we're going to compare a credit card with an ELOC, to see if we are better off doing Velocity Banking, if it belongs to this group, than doing Velocity Banking on the ELOC. Are we better off doing it on a credit card than we are on an ELOC? Okay. Current balance, interest rate, daily rate, and then we got income, results, we got interest rate, daily rate, okay, then we got expenses, results, interest rate, daily rate, and we have the average, and we have the number of days, and we have the interest charges for the month. All right. To have an apple-to-apple comparison in America, let's leave the current balance at $10,000 each. $10,000 on a credit card, $10,000 on an ELOC. let's say we know the interest rate on the credit card. Let's say the interest rate on the HELOC, because right now they're going, I don't know, 7, 8, 9, 10%. So let's just say it's 10%. Because we want to compare to see, are we sometimes better off to do movements of income and expenses inside a credit card instead of a HELOC. Now we know that the credit card interest rate is generally higher than the HELOC. So if the HELOC is at 10%, let's just say, okay, we don't want to be too dramatic here, so let's just say it's 21%. Okay? All right, we're going to run velocity banking on both, okay, to see, okay, which account should we run velocity banking on, okay? Because I want to prove to you that these groups sometimes make mistakes, okay? Talking about our competitive velocity banking. So let's do the one for the credit card real quick. $10,000 at 21%. What is the daily rate? Okay, so real quick. 10,000 times 21% divided by 365. So the daily rate should be 57534. 57534. I'll get my body out the way so you guys could follow along. Okay? 57534. Remember, on the credit card, on the last example, the income was 2,500. Okay? So 10,000 minus 2,500. So we should be at 75. The interest rate, 21% for this one. And the daily rate would be 7,500 times 21% divided by 365. Okay, so we should be at 43151. Okay, expense, if we're using the figure from the last example, expense was 21. Okay, so the results now, we got 75 plus the 21. So now we should be at 96. Okay, and again the interest rate 21%. So now the new daily rate, 96 times 21% divided by 365. So the new daily rate is 552. And again, we're mimicking what the folks over at Velocity Banking is doing. 55233. Okay? The average daily, again, we got how many items? 1 item, 2 items, 3 items. So let's add them up. We got 57534, 57534 plus 43151, 43151 plus 55233, 55233. Okay, divided by 3 items. So it should be, for average, 51973. Okay, and the number of days, let's say it's 30 days. 51973 times 30 days. We should be at 15592 for interest charges for the month. Okay? So now our effective rate is effective rate is 5. I'm at 18.97%. Okay? So that was doing velocity banking on a credit card, trying to compare an apple to apple. 10,000, 10,000. Okay? For an apple to apple comparison. All right. Now, let's run velocity banking on the HELOC now, 10%, 10,000 at 10% times 10% divided by 365. So now we have a daily rate of 2.7397. Okay. Income comes in, same scenario, 2,500 comes in. So 10 to 75, we should be 7,500, but let's do it just for good measure. So we had 75. Interest rate, this time the interest rate is 10%. Okay. Let's see what the daily rate is, times 10% divided by 365. So the daily rate should be 20548. Okay. Expenses, 2,100. So let's find out what the result is. We're at 7,500 plus the 2,100. So what do we got? What do we have? 96. Okay. The interest rate, 10%. So 96 times 10% divided by 365 to get to a daily rate is 26301. Okay. Now, for average, how many items do we have? We have 1, we have 2, and we have 3. Let's add these up. 27397 plus 2.0548 plus 2.6301. We should be at 2.4749. Now let me do that one more time. 27397 plus 20548 plus 26309 26301 divided by 3 2.4749. Perfect. All right, number of days was 30 days. And by the way, that's a good little formula that they use, okay? Because they use an average. In real life, these numbers may not be like that because it depends when income comes in and when expenses goes out. But since they're using an average, okay, this is a good little formula, okay? 2.4749 times 30 days. So now we add 74.25. Okay? And the effective rate should be 9.03%. Okay? All right. The original rate was 21% on this one. The effective rate for this one is 1897, which gives us a difference in savings percentage of 21 minus 1897, .03. Okay. Now the original interest charge, if you didn't do anything, if they did not do velocity banking on it, the original interest would have been 10,000 times 21% divided by 12 for the month. So that would have been 175. And the effective interest charge was right here, 15592. So the difference for doing velocity banking is 175 minus the 15592. So 1908 for doing velocity banking. Okay, and for this one, the original rate was 10%. The effective rate was 903. So now the difference that they saved, 10 minus 9.03 is 0.97%. And as far as the original interest charge, it would have been 10,000 times 10% divided by 12. That's if you did not do velocity banking at all. That's how much it would have been for the month. Okay, but the effective interest charge was $74.25. So they have a net gain of 93.33 minus 74.25, $9.13. Okay. Now, let's pay attention to these guys. Okay. If we do velocity banking on the higher APR card, which is the credit card, versus doing velocity on the lower APR card, which is the ELOC. Okay, let's see how we do. When we do velocity banking on the credit card, difference in interest in saving percentage is 203. When we do velocity banking on the ELOC, difference in interest savings is only 97.97. So where are we saving more? We have 0.97 here. We got 203 there. Okay? 97 only, 203. So we're saving more when we're doing movement of income and expenses on the higher APR account. Okay? Now, let's go down to the difference in interest cost savings. These folks over here, they were able to save $9.13. Look what we were able to do if we run it on the credit card itself. $19.08. So which one is bigger? We got $9.13 here. We got $19.08 there. Okay? And again, doing your movements of income and your movements of expenses inside the higher APR account will almost always be the best approach. Okay? So, in other words, the folks over at Velocity Banking, they choose the wrong account to do the Velocity Banking on. Okay? They were doing it on the lower APR, while they would have been better off doing it on the higher APR. Look at the results. The numbers don't lie. Look at the results. Look at the results. Greater than this. Greater than this. Okay? All right. Now, the next argument probably would be, James, we know that sometimes not every bills could go on a credit card. Here we have the entire 25 of income that goes in and the entire 21 of expenses that goes out. Okay? So we know, so in scenario like this, that I'm going to cover during our observation session, sometimes we use more than one alternative account, okay? The credit card will be first in line because the credit card will offer us the greater results in terms of reducing interest costs, and we proved it here. And the HELOC, because the HELOC offers greater liquidity, we will also use it. So in a case like this, we would use, if we were doing Ambroise Method 1.0, we would use two alternative accounts simultaneously, okay? Going forward, the next lesson will be lesson 4, that's Ambroise Method 1.0. So I will show you guys how to use two alternative accounts simultaneously when we have a scenario whereby the credit card cannot cover all the expenses, because we know that not every bills, not every expenses can be paid with a credit card instantly, okay? We're talking about instantly now. There are still creative ways whereby we could still have the credit card pay most bill or all bills, but we're talking about instantly. A credit card cannot pay all bills. There are certain bills that where a credit card, you cannot use a credit card to pay with, okay? All right, and that will be on lesson 4, all right, when we introduce to you guys Ambroise Method 1.0. All right, I'll give you about 5 seconds to take a look at what's on the board, and then we're gonna move over to, we're gonna talk about poor performing account, and we're gonna talk about the other velocity banking, okay? 5 seconds. All right, America, let's cover real quick what poor performing. In this example, the HELOC was a poor performing alternative account compared to the credit card, okay? So let me put that on the board. So the HELOC equals poor performing alternative account, okay? The same thing would have applied if the example were similar to a PLOC. So the PLOC would be a poor performing alternative account. The same thing would have applied to a BLOC. The same thing would have applied to an all-in-one loan. Poor performing alternative account compared to a credit card. The same will apply to a first lien HELOC. Poor performing alternative account compared to a credit card when the interest rate on these items, the BLOC, the PLOC, the HELOC, the all-in-one loan, the first lien HELOC, when the interest rate is considerably lower than the interest rate on the other account, okay? All right, so if it's considerably lower, it will be a poor performing alternative account compared to another account on the list that has a higher APR, okay? Now, understand though, sometimes, like I said earlier, we use two alternative accounts simultaneously. We could still use them, but they would not be first in line, okay? Because remember the order of things, the credit card in this example will be first in line, alternative account, and these guys will be next in line, alternative account, okay? Real quick again, first in line alternative account, that's the account that offers greater results in reducing interest cost, okay? That we prove to you on the board, greater results in reducing interest cost. And the next in line alternative account is the one that offers greater liquidity compared to another account on the list, okay? Greater results, greater liquidity. Which means if you have the options of choosing this one or choosing that one, For example, if it's a bill that can be paid on a credit card, well, which account should we use to pay the bill with? Well, instead of paying it with the HELOC, you will instead pay it with the credit card, because the credit card is first in line alternative account to the extent that you can. So for bills that can be paid with a credit card, I have an HELOC, I have a credit card. Okay, I should pay it with the credit card. Okay, and for best practice, and we're going to get to that later when we are analyzing the alternative account, because this account is a very dangerous account if you don't know what you're doing. So in the lesson down the road, we're going to break down, we're going to demystify, we're going to decode, we're going to analyze the alternative account. Okay, that's further down the road, America. So bear with me. Okay, I'm coming. All right. So, and we'll make the difference between what's a first in line alternative account and what's a next in line alternative account. Okay? All right, so 5 more seconds and then we're going to start erasing stuff from the board. All right. Okay. Okay. The next item we're going to talk about is velocity banking versus velocity banking. All right, so velocity banking versus velocity banking versus velocity banking. Okay? All right. Now, we're making reference now to the different guys who are on YouTube, okay, talking about velocity banking. Okay? On YouTube, you'll find some folks talking about how to pay off a mortgage inside 5 to 7 years. So, for lack of a better term, we're going to call these guys Group A. Okay? They're still doing velocity banking, but these guys, they're talking about mortgages. Okay? How to pay mortgage in 5 to 7 years. Okay? All right. Then you have another group. We're going to call them Group B. We're going to refer to them as Group B. These guys, they're not concentrating on the mortgage, they're concentrating on other debt. So let's just put other than mortgage. So the mortgage is not what they want to attack first. They want to concentrate on other than mortgage. Okay? And finally, we have another group. And these guys are more like salesmen. They're telling you they're selling product. Okay? Nothing wrong. Okay? I just want to make the distinction for you guys. They're telling you, hey, you need an HELOC to pay off debt, and here's a way we could help you get the HELOC. You need a PLOC to pay off debt, here's a way you could get the BLOC. You could get a life insurance, and using the life insurance, some of the proceeds, or use the life insurance in a way, to pay off debt. Okay? And we got some other ones talking about all-in-one loan, all new product, all-in-one loan first in HELOC, not a regular HELOC. Okay, first in HELOCs to pay off debt. So these guys, like I said earlier, they are salesmen because they're selling a product. Okay, that's why they specialize in. You see, so PLOC. You need a PLOC to pay off debt. Is a way I could get you PLOC. So BLOC. You need a BLOC to pay off debt. Is a way I could get you HELOC. Okay. Some of life insurance to pay off debt. Some of them are talking about all-in-one loan. And you got some of them talking about let's put life insurance here again. You got some of them talking about first in HELOC. Sometimes these two are interchangeable, but you got different products. First lien HELOC. Okay. Or any account, for lack of better terms, any account with a sweep checking account feature. Okay. I don't want to get too much into it so I don't confuse some of you guys. Okay. Let's just leave it at that because not everybody has the same level of knowledge. So let's just don't go too far into those things. Let me just mention them, and maybe on another video then I could go a little deeper into them. Okay. Now, premature celebration. Let's go here. What else we got for cash flow? And we're gonna go over all that in a second. Okay. For the mortgage, these guys. And what else we got on the board? Okay, so let's move down to these guys. They want to attack debt other than mortgage. So they kind of have premature celebration. You're gonna bear with me, guys. I'm gonna go over all that. Just put them on the board. Okay. These they don't do mortgage because they do other debt. Okay. And those guys over here, it's restrictive. And alright, so these guys could be okay. Alright, I think I got every item from the list. Alright. Alright. we got this different group like I mentioned earlier. We got a group online, these YouTube guys, those guys on YouTube talking about this is how I could help you pay off a mortgage in 5 to 7 years. Okay. Now, since they concentrate on the mortgage, okay, they're not worried about anything else. And these guys usually talking about how they're doing better than that snowball, how they're doing better than that avalanche. And in a way, they are doing better than that snowball, they are doing better than that avalanche, but I call it premature celebration. Okay? Because what do? They're attacking a mortgage. We know that the interest rate on a mortgage is usually lower than the interest rate on a credit card. Okay, so they're ignoring the credit card, they're ignoring everything else, personal loan, whatever else, other items that they have. These folks mostly want to concentrate on the mortgage. Okay? Now, in the beginning, of course, and they're boasting about how much interest they were able to save. Of course, in the beginning, whether it takes some 5 years or 7 years, you're gonna do better than other people, okay? But if you would have leave the mortgage alone because the mortgage is at a lower interest rate, and you would have concentrated instead on the other item that you have on the list, okay, you would have been better off. So for that reason, we call it a premature celebration, because at one point they might be doing better than everybody else. But remember, when you're paying off debt, you have to have a holistic approach. Okay? You have to have a holistic approach. So it's not after I pay off one debt, two debt, I'm ahead and I need to start celebrating already. No. Okay? Remember, it's the whole debt, all the debts. So you might start early, and at some point, either that snowball gonna catch up to you, or that avalanche will catch up to you. Especially in that case when they're using the wrong debt weapon, like we showed you earlier. They're using the HELOC when they should have used the credit card instead. Okay? So premature celebration. And another issue that they have is that these guys, when they're using the HELOC as a debt weapon, they want to wait 3 months, 6 months, 9 months, 1 year to make the next chunk. Okay? What happened? We know that the interest rate on the HELOC is usually really smaller. So each month that you're keeping the money inside the HELOC, okay? So you're saving, say you're saving 3.99%, but you're losing somewhere else 21%, 25%, 29%, whatever other account that we have on the other side, okay? So when you wait, you're gonna lose, because when you're paying off debt, you shouldn't have to wait. As you have the cash flow, go ahead and send it in, okay? Don't keep it inside the HELOC for 3 months. Don't keep it inside the HELOC for 6 months. Don't keep it inside the HELOC for 9 months. As soon as you have it, send it over to the other account with the highest APR. And I'll probably do another lesson on that down the road, okay, to kind of break it down to you guys, okay? So when you wait on the cash flow to keep it inside the HELOC for 3 months, 6 months, 9 months, you wait, you're going to lose, because you're going backwards. You're saving, say, 3.99% or even 10% on the HELOC, but you're losing somewhere else 21%, 25%, 29%. Now, it is true that using the HELOC as a debt weapon gonna give you a boost, but the difference in interest, on the interest that you're being charged, the difference is too large. The boost that using the HELOC as a debt weapon will give you is not going to be enough to catch up to the difference. Look at this difference. 21, 3.99. That's almost 21, that's almost 17%. Okay? So in this case, it will be 29 and 2, that's almost 19%. If we're looking at these two. See? Doing the HELOC on the lower APR card cannot make up for the difference in interest costs that you're being killed on one of these other accounts. Okay. And on the mortgage, we call that event priority. Whenever you decide to ignore everything else, okay, and you just want to concentrate on one account and one account only, okay, we call that event priority. In the book, I describe event priority as an event whereby one event takes precedence over everything else. In this case, since they're attacking the mortgage takes precedence over every other debt that they have. They don't care what the other debts are doing, they just want to concentrate on the mortgage. And we know, like I mentioned earlier, that the mortgage interest rate is usually lower. Okay? Not always, but 99% of the time it's lower than a credit card. Okay? Now, for this group, okay, and by the way, since this group talking about this is how much interest I'm being saved, they resemble more so that avalanche. Okay? Because that avalanche is the only one out of the 4 grab and go method, okay, that concentrate more so on the interest charge or how much interest I'm being saved. Okay? Because remember that avalanche look at the interest rate, the APR, I'm sorry, and wants to attack the highest APR. Since these guys are always talking about this is how much interest I'm being saved, I'm saving you, so they resemble, even though they're not doing it, but indirectly, they resemble more that avalanche, okay? Now, this other group, group B, same thing, premature celebration. Hey, I'm doing better than that snowball, I'm doing better than that avalanche, because they don't have a holistic approach about all the debts, the global debt that they have on the board, okay? Same thing, they're using they want to wait on the cash flow, they're dumping all the cash flow inside the ELOC, and 3-6 months later, they want to then chunk, and we know it's a mistake to wait, and again, you wait, you lose, okay? And in the case of an ELOC, they're using the ELOC as a holding account. So they're dumping everything inside the ELOC. They're using the ELOC as an escrow account. So at a later time, 3 months, 6 months, 9 months later, they could send a chunk. Okay? Do not wait. Okay? As you have the extra cash, you gotta send it. Okay? Because if you're holding it at a 3.99% and you're being killed somewhere else at 21%, that don't make no sense. Whether you're doing velocity banking on it, it's not gonna make up for the difference in interest saving because you're being killed somewhere else. Okay? And same thing, they do not have a holistic approach, because as soon as they pay 2-3 bills, they're bragging already about how good they're doing compared to a debt snowball, how good they're doing compared to a debt avalanche. Okay? So now, these guys, the new thing now is how much cash flow I'm able to save. So whenever you're talking about cash flow, you resemble more, whether directly or indirectly, you resemble more the monthly payments charge. Remember the 4 grab and go method, guys. We got debt avalanche, debt snowball, monthly payments charge, and payment rates charge. Okay? They resemble more monthly payments charge. And sometimes the results of monthly payments charge, in some example, not all, is the same as the result of a payment rate charge. And by the way, if you guys don't know what I'm talking about when I'm covering 4 grab and go method, please watch my previous lessons, because remember, the way I want you guys to watch those lessons, watch lesson 1 before you watch lesson 2, watch lesson 2 before you watch lesson 3, okay? So all these things were covered in the previous lessons. That's why I don't want to spend too much time on them here, okay? So again, they resemble more monthly payments charge because they are bragging about how much cash flow gains that they were able to do. The next word I see them, the latest word I see them use is cash flow recovery. Okay? So because they're bragging about cash flow, directly or indirectly, they resemble more of a monthly payments charge. And since the monthly payments charge, like I said earlier, can be the same with the payment rate charge. So indirectly, they also falls into that category. They fall into that category, payment rate charge. Okay. And with that snowball sometimes brag about cash flow as well, because that snowball is attacking the lower balance. So indirectly too, they resemble more that snowball. So you got this group that resemble that avalanche, whether directly or indirectly, because they're bragging about interest costs that they're saving. And you got these other guys talking about cash flow. Okay? So between those two, you got one group on YouTube talking about interest charges, how much they're able to save, and you got another group that could be any of those three. So for that reason, they do not have a cohesive message. So no cohesive message. Okay? You got one group bragging about one thing, you got another group bragging about something totally different. Okay? You as the regular Joe, you're in the middle, you're trying to figure out, wait a minute. Where do they want me to go? Do they want me to be that avalanche? These guys are doing it indirectly, or do they want me to be one of these other methods? Okay? Referring to the 4 grab and go methods. Okay? Alright, so that's the difference. And finally, you have these guys. They are more like salesmen. Hey, I could get you a PLOC to pay off debt. I could get you a BLOC to pay off debt. I could get you a HELOC to pay off debt. I could get you a life insurance to pay off debt. Okay? In the case of the HELOC, remember, to get an HELOC, you have to have a house. And there's a percentage of Americans who do not own a home. Okay? And I can't remember the statistic. I think it was like 34% or something. I can't remember. But to be safe, let's just say more than 1/3. So more than 1/3 of Americans, or people living in America, are renters, not homeowners. They are renters. Okay? More than 1/3. Okay? So, which means if you're talking about HELOC, all-in-one loan, first lien HELOC, so your program or your plan or your method is very restrictive. Okay? And again, like I aforementioned, not everybody has a house. We got some renters in America. So with these guys, they cannot cover the entire population. Okay? Now, Ambroise Method 1.0, for us, our method, Ambroise Method 1.0, is inclusively helpful for homeowners, renters. Okay? Because we're not telling you to go out there and get a PLOC, BLOC, HELOC. I've already proven earlier that these accounts are poor performing alternative accounts when compared with a credit card with a higher APR. We proved that earlier. Okay? Our method is inclusively helpful for rich individuals. So the Donald Trumps of the world could use my method. The Obamas of the world could use my method. Ambroise Method 1.0 is inclusively helpful for high-income earners. So the doctors, some lawyers could use my method. But more importantly, Ambroise Method 1.0 is inclusively helpful for the 64% of Americans who are living paycheck to paycheck, and the 68% of us who cannot come up with a $400 emergency. So we cover everybody with our method, Ambroise Method 1.0. Okay? Everybody. All right, guys. I'll give you another 5-10 seconds to take a look at what's on the board, and I'm going to start erasing stuff from the board. All right. Now, next up is our observation section. you know that we always compare our method with that snowball. We always compare our method with that avalanche. And we always compare our method with velocity banking. Okay? And this is Ambroise Method 1.0, our basic version. Okay? I got another version that I'm working on. It's Ambroise Method 2.0. On this version, we cover more complex scenario, more complex case study. Okay? But we're talking about Ambroise Method 1.0 because I want you guys to get the foundation first before I start introducing, complex scenario to you guys. Okay? Now for that snowball, we know they've only used cash flow. For that avalanche, we know they've only used cash flow. For velocity banking, we know they've used cash flow. And in addition to cash flow, these guys chunk. And these guys also use a debt weapon. Okay? For our method, we have two different kind of users. We have what we call a normal user. Let's just put normal. And we have an advanced user. Okay? And we're going to cover that in a second. But for Ambroise Method 1.0, we transfer. And we do transfers between current existing accounts. Okay? This is not debt consolidations, America. This is transfers between accounts that you already have. The same debt that you already have. I'm not telling you to go out there and go apply for a new credit line, new trade lines. We're using the same debt that you already have, okay? And for transfer, we have a normal transfer. Okay, so I probably need some room on this board. And we also have what we call an artificial transfer. That's a transfer when we employ another of my techniques that are called Ambroise charge pay technique. Okay? And we have two variations of it. One of them we call it normal. And we have another variation of that we call Ambroise charge pay technique. And this one is inducement. artificial transfer, we also use plastic, melio, and similar entities. Okay? And we also have mix and match. And again, we're going to go over all that and we repeat. Okay? For alternative accounts, we have ADAWA, which stands for alternative deposit, alternative withdrawal account. And for short, we call it ADAWA. Okay. And sometimes we use one alternative account, sometimes two, sometimes three. One alternative account, two alternative account, simultaneously. Okay? And then three alternative account simultaneously. And again, I'm going to go over all this in a second, America. And this one is one alternative account. That's when we're doing Ambroise Method 1.0. Two alternative account. That's also the basic version, Ambroise Method 1.0. And three alternative account. That's part of our advanced course, Ambroise Method 2.0. Okay, plastic is also Ambroise 2.0. Okay, and just like everybody else, we also use cash flow. Okay, that is our observation session. Now, James, what's the difference? Well, that snowball only uses cash flow. Because you know that snowball likes to attack the lowest balance first, which means because the fixation is on the lowest balance, they're not going to pay too much attention with the higher APR. So for that reason, they are not concerned with the highest APR, okay? Because all they want to attack is lower balance, lowest balance, lowest balance, okay? So they're not going to pay attention to the highest APR. In addition, since they only use cash flow, they're not going to take advantage of different types of balance transfer we have on the board, okay? And real quick, let's talk about this. First, I mentioned a normal user, because our method got two different kind of type of users. A normal user for our method is one that uses transfer. So the normal use transfer, and they also use cash flow. That's a normal user, okay? A normal user does not take advantage, does not utilize alternative account. Why? Because a normal user only uses their regular checking and savings account. So these people, they are not comfortable yet in using an alternative account, okay? So they use transfers and they use cash flow, okay? So, and these guys, just the checking account to pay off debt, okay? Now, a normal user will still do better than that snowball, will still do better than that avalanche, because a normal user, in addition to using cash flow just like everybody else, they also doing transfer. So they're doing one more item then say a dead snowball, then say a dead avalanche, okay? And an advanced user obviously take advantage of everything that's on the board. Transfer, alternative account, cash flow. Okay, sometimes I refer to those as TAC. Okay, TAC, T-A-C. T for transfers, A for alternative account, and C for cash flow. Okay? Now, real quick, a normal transfer, that's a transfer between same account type. Okay? And we're going to cover all these in greater details in later lessons. Remember, I cannot dump everything at you guys all at once, so I'm trying to break it down by lessons, okay? So bear with me, okay? So we're going to cover everything when it's all said and done. A normal transfer is a transfer between same account type, which means it could be a revolving and another revolving, same account type, like a credit card, for example. So you're transferring from one credit card into another credit card, okay? An artificial, well, let's do mix and match first. A mix and match is a transfer between different accounts. So the normal one is same account type, mix and match is different. In this example, it could be an installment credit account and a revolving credit account. For example, the installment could be a student loan that you're trying to move over into a credit card. It could be a personal loan that you're trying to move over into a credit card. So installment and a revolving, okay? And by the way, be extremely careful with student loans, and we'll cover that down the road. Artificial type of transfer is a transfer whereby I use a technique called Ambroise's charge pay technique, okay? This technique will be in the book. I haven't published the book yet, but you know, I'm still working with my publisher, and so we'll get to that when the time comes, okay? Ambroise charge pay technique. It's a way to do transfers between accounts where you pretty much fire the big bank, the big creditors. You fire them. So you don't need Wells Fargo to do your transfer. You don't need Capital One to do your transfer. You don't need Chase to do your transfers, okay? You could execute your own transfer without the help of the big bank, of the big creditors, okay? This is good stuff, man. Okay, and when we get to that lesson, well, I'm not sure if we're going to cover that lesson because it's in the book, but it is a way to do transfer where the transfer will cost you $0 in balance transfer fees. Okay? And again, with that type of transfer, with this technique, you do not use the big bank, the big creditors, okay? They are fired. And I also have another variation of it, Ambroise's charge pay technique, inducement. So this one's going to cost you something, but you'll be lower than what the big bank, the big creditor will charge. So understand that the big bank, the big creditors in 2023 are charging between 3.5% to 3 to 5% to execute a balance transfer for you. Okay? Here, and the inducement one, you want to be lower than what the big bank, the big creditors are charging. On one, we fire the bank. On another, we're trying to be lower than what the bank is doing. Okay, so we don't need the bank for the first two. Okay? So here, we're trying to be under 3 to 5, so we could be 0.01 all the way to 2.99%. Because we want to be lower than what the big bank, the big creditors are charging, okay? And other time we use plastic or Melio or similar entities to execute our balance transfers, especially plastic, okay? And I do not cover that on our basic version 1.0. I cover plastic on our advanced version 2.0, okay? Now, after all that is done, guess what? We try to repeat the process of transferring again to the extent that we can. So, okay, trying to repeat. Now, moving down to alternative account, I call it a DAWA for short. That's an alternative deposit, alternative withdrawal account. That is an account that works similarly to a checking account, okay? Income comes in, expense goes out. In other words, deposit comes in and withdrawal goes out. And sometimes we use one alternative account in our method. Ambroise Method 1.0 will cover that. Sometimes we use two alternative accounts simultaneously, okay? And I'm gonna show an example where we use a credit card with an HELOC down on my next lesson, okay? Ambroise Method 1.0 when we introduce Ambroise Method 1.0, okay? And sometimes we use three alternative accounts. This one is revolutionary. Because nobody in America is using three alternative accounts. We are the first in year 2023 who are using three alternative accounts simultaneously. That's doing what the other group would be doing velocity banking on three different accounts at the same time. But for us, we have movements of income and expense. That's doing movement of income and expenses in three separate alternative accounts at the same time, America. Okay? So this is revolutionary. So in addition to all the new techniques that I'm bringing to the fore, I'm also doing new stuff. Okay? Three alternative accounts, never heard of. Okay? Nobody in America is doing this. Okay? And then for our method, obviously we use cash flow. All right, real quick again, compare with that snowball. You're using cash flow only. They're not concerned about higher interest rate card because their main fixation is on the lower balance. So they're not taking advantage of all the different transfers that we do. And they also do not utilize alternative accounts. So that was that snowball. Now, that avalanche, just like that snowball, that avalanche also use cash flow. That avalanche does not take advantage of different type of transfers that we have on the board, okay? Because all they do is using cash flow, okay? And that avalanche does not, just like that snowball, they do not utilize alternative account, okay? As you can see, these guys are doing one thing, and we're doing more, okay? We're doing more. We're doing three items. We're doing this right here. We're doing that. And we're doing this. Okay? This is our tag. Transfer, alternative, cash flow. That's our tag. We're doing three items. All they're doing is just the C. Okay? All right. And we have a saying here at Ambroise Method 1.0 that these guys, they like to toy with the debt. They like to play with the debt. Here, we aggressively trying to get rid of the debt. Look at how many different things we're trying to do. Okay? Ambroise Method 1.0 is a very aggressive method. We don't want to toy with the debt. We want to aggressively get rid of it. Okay? So every opportunity that we have, we're trying to do all those things. Sometimes we can do most of them. Sometimes we can't. But we always attempt to do all of them. Okay? All right, now, velocity banking. We know that these guys chunk, okay? And sometimes they only do one transfer at a time, okay? You know they have to wait another 3 months, another 6 months, another 9 months, another 12 months to execute the next transfer. Look at us. We're trying to do transfer inside one day. We're trying to do all those different transfers, more than one. Inside one day, sometimes inside a few hours, sometimes a few minutes apart, sometimes a few seconds apart, okay? We don't wait 3 months, 6 months. Remember, you wait, you lose. So we have to execute those transfers fairly quickly, okay? In some cases, just a few minutes apart, okay? We don't wait 3 months, we don't wait 6 months, we don't wait 9 months. And velocity banking uses a debt weapon. Sometimes they use just one debt weapon. And I've seen a few instances where these guys use two debt weapons. Okay? And from the example earlier, we know when they use a debt weapon, sometimes they pick the wrong debt weapon. In the example earlier, they should have picked the credit card, but instead they picked the ELOC. Okay? And we know that an ELOC compared to a credit card is a poor performing alternative account if the interest rate on the ELOC is considerably lower than the interest rate on the other account. Okay? So we use one, we use two, and like I mentioned earlier, sometimes we use three simultaneously, which is revolutionary. Nobody else is using three alternative accounts. Okay? So that was the comparison between these other debt repayment method. All right? All right, America, I'll give you about 5 seconds to take a look at what's on the board, and then we're gonna try to wrap up the exercise. All right, on the example earlier, remember the ELOC, velocity banking, these folks, they use the ELOC for chunking, region ELOC. They also use the ELOC as a debt weapon or debt tool. And they've also used the ELOC to keep the cash flow. Okay? As you could see, they use the ELOC everywhere. ELOC to chunk, ELOC as a debt weapon, ELOC as a cash flow. Because I want to cover with you guys favoritism. Okay? Here over at Ambroise Method 1.0, we practice no form of favoritism when it comes to paying off debt. Okay? For the TAC, for the T, for the A, for the C. Okay? We treat each of these items as a separate job. Okay? For the transfer, it is the account that is best suited for the job. If the ELOC is best suited for the job, fine, we'll go with the ELOC. In that case, the ELOC was best suited for the transfer, for the initial transfer, the 10,000 that they've used to knock out the 4,000 Wells Fargo and to knock out the 6,000, I believe it was Capital One. Okay? So that wasn't a bad move. Okay? They used the ELOC to chunk. That was beautiful. Okay? Because the ELOC had a lower interest rate. In essence, you move your higher APR balance into the lowest interest rate balance. So that was a great move. Okay? But now, on the A, on the debt weapon or on the alternative deposit, they're using the ELOC, okay, which was the wrong move. They should have used the credit card instead. Okay? And on the cash flow, the ELOC, region ELOC kept the cash flow. That was also the wrong move. Okay? The credit card should have kept the cash flow because the credit card was a higher APR. And I think the credit card was Chase, I think it was. Okay? So it seems like they're practicing some form of favoritism and using the ELOC for everything else. ELOC's here, ELOC's there, ELOC's there. Okay? Remember, the T, the A, and the C, they're all different jobs. You have to use whichever account or accounts that are best suited for the job. Okay? So if ELOC is best suited for it, fine. But if another account is best suited to be the debt weapon, they should have used another account. Okay? So we have no favoritism on our side. We always look to see which account is best for that job, which account is the best approach. So that's the account that we use. Okay? Yeah. We don't have no kind of favoritism no kind of fanaticism when it comes to paying off debt. Okay? Alright guys, let's start getting, I think that's it for me today. On the next lesson, again, lesson 1 was debt snowball. Lesson 2 was debt avalanche. Lesson 3, this lesson was about velocity banking. The next lesson will be lesson 4. That's when we're going to introduce to you guys Ambroise Method 1.0. Again, America, my name is James Ambroise. I am the author, creator of Ambroise Method 1.0, our basic version. Ambroise Method 1.0 is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to debt snowball, debt avalanche, velocity banking. Okay? Until next time, America, good morning.